And again, I'm reading this book. Haven't finished this yet. I don't know how many days it would take me, but I'm supposed to finish this book by now. But I don't know why I haven't finished with my dark circles. So, to talk about today's chapter, I think I have few of them. So, today we have, I don't know, like two chapters. I am gonna read two chapters today. So, I think, I don't know, I should read aloud or I will do that. 15. Nothing's free. It would be good like if I could show like what I'm writing at the moment, but I can't obviously. So nothing's free. Everything has a price, but not all prices appear and level. This one is dope. Everything has a price, but not everything has a price, but not all the price appears on level. This one is secret. Let's see what it tells in this chapter. Everything has a price, and that the key to a lot of things with money is just figuring out what is that price and being willing to pay. The problem is that the price of a lot of things is not obvious until you have experienced them firsthand when the bill is overdue. General Electric was the largest company in the world in 2004, worth a third of trillion dollars. It has either been first or second each year for the previous decade. Capitalism shining example of corporate what the hell was aristocracy. Then everything fell into pieces. The 2008 final crisis sent this finance division, which supplied more than half the company's profit, into the chaos. I forget to read, bro. I mean, I used to know how to read, but now I'm completely off this. I need to look at the videos how to study. The 2008 financial crisis sent G's financing division, which supplied more than the half company's profit, into chaos. It was eventually sold for a scrap. Subsequent bids in oil and energy were disaster, resulting in billions in write-offs. G stock fell from $40 in 2007 to $7 by 2018. Blame placed on the CEO Jeff Imlet, who ran the company since 2001, was immediate and harsh. He was criticized for his leadership, his acquisition, cutting the dividend, laying off workers, and of course, the plunging stock price. Rightly so, those rewarded with dynastic oil when times are good hold the burden of responsibility when the tides go down. He stepped down in 2017, but Imlet said something insightful on his way out. Responding to crisis, who said his actions were wrong and he should have done was obvious. Imad told his successor, every job looks easy when you are not doing it. This one is so good. Every job looks easy when you are not doing it because the challenges faced by someone in the arena are invisible to those in those crowd. Yep, this is when you are during the conflict demands of sprawling board, plots, short-term investor, regulator, union, and entrenched bureaucracy is not only hard to do, but it's hard to even to recognize the severity of the problems until you are the one dealing with them. Immediate successor who has last 14 months learned this is well. Most things are harder in practice than they are in theory. Sometimes this is because we are overconfident. Most often it's because we are not good at identifying what is the price of success. It is which prevents us from being able to pay it. The S&P's 500 increased 119-fold in the 50 years ended 2018. All you had to do was to sit back and let your money compound. But of course, successful investing looks easy when you are not the one doing it. Holding stocks for the long run, you will hear it's a good advice. But how do you know how hard it is to maintain a long term outlook when stocks are collapsing? Like everything else worthwhile saving, successful investing demands a price. But its currency is not dollars and cents. It's volatility, fear, doubt, uncertainty, and regret, all of which are easy to overlook until you are dealing with them in real time. Oh, the inability, the inability to recognize that investing as a price can tempt us to try get something for nothing, which like shoplifting rarely ends well. So you want a new car, it costs $30,000. You have three options: pay $30,000 for it, find a cheaper used one, or steal it. In case 99% of people know to avoid the third option because the consequences of stealing a car outweigh the upside. But say what you want to earn 11% annual return on the next 30 years. So you can retire in peace. Does this reward come free? Of course not. The world is never like that. There's a price tag, a bill that must be paid. In case it's never ending taunt from the market, which gives big returns and take them away just as fast, including dividends. The Dow Jones Industrial Average return price 11% per year from 1950 to 2009, which is great, but the price of success during the period was dreadfully high. The steadiest line in the chart went at least 5% of blue people at the highest time. And this is the chart is saying about this is the price of market returns, the fee. It's the cost of the admission and it hurts. Like most products, the bigger the return, the higher the price. The bigger the product, like most products have bigger returns, the higher price. Netflix stock returned more than 3,500 from 2000 to 2018, but traded below its previous all-time high on 90% of the day. Most now here's the important part. Like the car, you have a very few options. You can pay the price accepting volatility and of evil, or you can find an asset with less uncertainty and a lower payoff. So my reading skill is gone because I was doing silent reading, and so while I was doing silent reading, then I'm not talking too much. So the thing that I have learned how to speak is just boom gone. But it doesn't matter. I will get back. Many people in investing choose the third option like a car thief. Though well-meaning and law-abiding, they form tricks and strategies to get return without paying the price. They trade in and out. They attempt to sell before the next recession and buy the before the next boom. Most investors with even a little experience know volatility is real and common. Many of them take what's in like next logic is trying to avoid it. But money gods do not look highly upon those who secretly without paying the price. Some cards will get away with many will be more current one is same thing with investing. Morningstar wants to get the performance of a tactical mutual fund with strategies to switch between stocks and bonds opportunate times, capturing market trends with lower down risk. They won the return without paying the price. The study focused on the mid 2010 through late 2001 period when US markets went wild and faced a new recession and S&P declined more than 20%. This is exact kind of environment the tactical funds are supposed to work in. It was the whole moment to shine. You have to pay the price. You have to pay the price. Volatility. Volatility. I don't know, like volatility. Volatility. Volatility is the price. It's not the price, but there were by Morning's account 112 tactical mutual funds during the period. Only 9 had better risk adjustment returns than a simple 640 stock bond fund. Less than a quarter, the tactical funds had smaller maximum drawdowns than the liquid earnings. Morning's account. With a few expectation technical gain, less were more rare and subject to is more down risk. It's hands. Individual investors fall for this when making their own investments. I mean, I need to stop talking and then go silent. I can't focus like if I am talking. So yeah. The trick is convincing yourself that the market freeze is worth it. That's the only way to properly deal with volatility and uncertainty. Not just putting up with it, but realizing that it's an admission fee worth paying. There is no guarantee that it will be sometimes. It will at Disneyland. But if you view the admission fee as a fine, you will never enjoy the magic. Find the price and then pay it. So it means that if you invest money in some kind of portfolio or not the portfolio but some stocks, then you have to pay the price. You don't earn money is always. You pay for the volatility of the market. If the market crashes, then your money is gone. So, but at that time, you don't have to panic. I think he was trying to say that nothing is free. If you earn money, then you have to pay the fine. The fine is the volatility of the market that the market captures, the way market spends your money, the way market crashes sometimes. And he talked about one thing mainly. So the company which stock was around $40 in 2007. It crashed to $7 in 2018. So it's a bad situation, but you have to be very cautious. You have to take decisions. You might have bought the stocks for $4. Still, that was a profit for you, but in the long term, you have to pay the price, no matter what. So the price isn't always labeled as this dash dot cents or uh, dollars. Is the volatility of the market that you pay for. So I think I just did the chapter 15. I could read this one, but I have to go and I will be late. It will be late. I could read this one, but check the time. It's 6:33. So it's a kind of late. I will be late. So yeah, see you tomorrow. This is a really short video. I don't know why. It's because I don't have enough time, I would say. Let me figure out. Uh, let me figure out the time it takes for me to reach somewhere that I need to go, and then I would consider tomorrow 22 chapters. So see you guys. Bye bye. And actually no. So read this book if you want. If you clicked on this video, I should have said this in the first, but if you click on this video, then read this book, guys. Trust me. Trust me. Read this.